Auditing risk consists of recognizing some level of risk or uncertainty within a client's business, such as the appropriateness of evidence, misstatements in the financial statement, and the effectiveness of client's internal control. The audit risk model for planning helps auditors decide how much and what type of evidence are needed to accumulate in each cycle. Auditors will analyze a client's business cycle or operations such as sales and collection cycle, acquisition and payment cycle, payroll and personnel cycle, inventory and warehousing cycle, as well as capital acquisition and repayment cycle. Based on this analysis, auditors will assess the client's risk.
Next, we will continue with audit risk model components. Firstly is plan detection risk. Plan detection risk is the risk that audit evidence for a segment will fail to detect misstatements exceeding tolerable misstatement. Basically, plan detection risk is to calculate of how much audit evidence for a segment that the auditor will fail to detect misstatements. There are two things that we need to know about the plan detection risk. Firstly, this risk is dependent on the other three factors in the model, which is inherent risk, control risk, and acceptable audit risk. It will change only if the auditor changes one of the other risk model factors. Next, plan detection risk determines the amount of substantive evidence that the auditor plans to accumulate inversely with the size of plan detection risk. If plan detection risk is reduced, the auditor needs to accumulate more evidence to achieve the reduced plan risk.
Control risk. A risk that measures the auditor's assessment of whether misstatement exceeding a tolerable amount in a segment will be prevented or detected on a timely basis by the client's internal controls. Second, need to obtain an understanding of internal control. Lastly, when the controls are ineffective and inherent risk is high, this will cause the auditor to decrease plan detection risk, thus increase the plan evidence.